right, good morning or good afternoon, depending on where you're signing in from in the world. Welcome to Giga Metals live investor event hosted by Six. We're joined today by the company's CEO and chairman, Mark Jarvis, and manager of development, Lyle Trytten. Mark and Lyle are here today to review the details from the recently announced pre-feasibility study, as well as answer your questions in a Q&A session. And you don't have to wait for the Q&A to submit questions. You can submit them at any time using the chat panel found on the right-hand side of your screen. As always, today's event is being recorded. It will be available to all registrants as well as the general public soon after the event concludes. But without further ado, I'm going to hand it over to Mark and Lyle to kick things off with their presentation.
Well, first of all, I want to just welcome everyone here and to say this is a really big deal for us. Completing this pre-feasibility study is wonderful. We've gone through a significant de-risking of our project, and we've got a lot more confidence in every single part of this than we had at the PEA level. So I'm just with that, I think I'll just get started and go through this. This is a standard disclaimer. So just to review quickly, Hard Creek Nickel Corp is the joint venture company of which Mitsubishi Corporation owns 15% and we own 85%. And we have been working with Mitsubishi very closely in putting this pre-feasibility study together. Mitsubishi also had their own outside engineering group that was monitoring the situation, a very conservative engineering firm that was making sure that everything we were doing was realistic, which is how we do things anyways. But they also had, at times, very good suggestions. It was quite a collaborative process. So here's some of the highlights. We're looking at 37,000 tons a year as a typical annual output of nickel and cobalt. Just to give some idea of the scale, that is a similar scale to, the big, or I could even say the giant, high pressure, high temperature acid leach projects, HPAL projects, processing laterite in Indonesia. Those projects, typically, my understanding is their capital cost is about $3 billion. So we're getting to that kind of level of output for less than $2 billion, which is still an awfully big number, but it is a competitive number. We've got a 30-year project life as modeled here with the measured plus indicated resources. We will produce consistently, and this is one of the things that's important to us, we will consistently produce a very high quality concentrate. And our operating cost to produce a pound of nickel at the site gate is $3.85 a pound. And that is before transportation, it's before byproduct credits. And then the C1 cost, which includes the fact that we'll be paying a tolling price of about 22% to the smelter. So once it's smelted, the payable nickel all in is about $4.65 a pound. And again, simplicity. Our flow sheet, we were having a discussion about it. It looks very much like the flow sheet for a copper porphyry project, except even simpler. So, and that simplicity is important. The fewer steps you take, the less risk there is in the flow sheet. And everybody likes a low risk project. And I think Mitsubishi was quite delighted by that. We did a geometallurgical program. Actually, I'm going to ask Lyle to step in and describe the geometallurgical program, if you will, Lyle.
Sure. Thanks, Mark. And a pleasure to be with you all today. The geometallurgical program we undertook over the last year was really designed to look at the overall deposit and determine are there differences in how the deposit behaves given the different ore types or locations, physical locations in the deposit? We picked 70 samples from around the deposit in consultation with the geometallurgical specialists, had all of those tested through our standard flotation process. And what we discovered at the end of the day is, unlike a lot of deposits that have a lot of complexity to them, we have one recovery algorithm that fits the entire deposit. It doesn't matter where the ore is physically located. It doesn't matter what the dominant rock type is. That varies a little bit. The recovery algorithm is really very consistent, and that gives us a huge amount of confidence. When you go to operate a mine, you don't want to be guessing, is this part like A or like B? We know it's the entire deposit operates on the same recovery algorithm. Of course, there's a range of recoveries across the deposit, but that's very predictable for us.
And if I can say, part of what gives us confidence is that, in order to understand the cash flow from this project, you have to be able to predict what your recoveries are from all these different parts of the deposit. And the algorithm that's been developed, this is a huge success. The error bars between predicting what the recovery will be, and then when you do the metallurgical test and you actually recover nickel, the error bars are very narrow. And so that, is a huge de-risking step for us. And I know, if you're not an engineer, it might not sound that exciting, but the engineers are very excited about this. Another thing I'd like Lyle to talk about, by the way, Lyle is, a world expert on, hydrometallurgy. So we're modeling that we're going to sell to a smelter, and we're running all of our cash flow models on, a 78% net payable for nickel and 50% net payable for the cobalt contained in the concentrate. And the reason we're modeling selling to a smelter is that that's a market that exists. And it's a market that's well understood. It's been a market for more than 100 years. And so, we can assign payabilities and so forth to that with a lot of confidence. But we also believe that the market will change over the next decade or two. We think people are going to be building refineries at some point. They're going to have to. If they want to supply, if you want a supply chain to the cathode market in North America and Europe, you're going to have to refine. And pressure oxidation circuit is very suitable technology to process our concentrate. And so, Lyle, if you could talk about that a little bit.
Sure. And, I'd like to start off by saying there's nothing wrong with smelting a concentrate like ours. Smelting is a great technology for getting rid of the impurities of, the major impurities, iron and sulfur, magnesium silicates, and making a good product, a nickel matte that can then go for further refining. It's just that smelters are expensive to build and are generally very large. Pressure oxidation is an alternative route that's been around for a long time. I spent many, many years working in the world's first concentrate pressure oxidation plant for the nickel business at Sherritt's refinery here in Fort Saskatchewan. There's been 3 built around the world to treat concentrate over the decades. Going forward, this is a route that is technically very straightforward. It's very much like a refractory gold pressure oxidation, such as is run in areas from the United States to Africa to Papua New Guinea. You can make multiple different products out of it. Once you've dissolved the nickel into solution in a pressure oxidation circuit, you can make an intermediate like a mixed hydroxide or a mixed sulfide. You can make a nickel sulfate. You can make a class 1 nickel cathode or briquette. There's lots of options there. And they're especially suited to being built for smaller capacities. So whether it was designed for our facility alone or for multiple facilities, you can run them at much lower rates than you can run a typical smelter. It's a very straightforward technology. Pressure oxidation to oxidize the sulfur. Don't need to add a lot of reagents to it. Neutralization to get rid of some of the impurities. And then you're into the nickel and cobalt recovery circuit.
Thanks, Lyle. So also this mine will be a very large open pit with an extremely low strip ratio. The carbon intensity has gone down since the PEA. We're less than 1.8 tons of CO2 per ton of nickel. And that's partly because we're using trolley assist for the diesel trucks that are hauling the ore out of the pit. And we're planning to use, autonomous driving of those trucks. And that saves burning diesel. Now, as the market evolves, we expect that there will be fully electric haul fleets probably by the time this mine gets built. But since they don't exist yet, we are not going to model them in our PEA. And I'm also, Lyle, I'd like you. Actually, we're going to get to this a bit later. The tailings sequester CO2, and they've been very well designed, but we've got a slide on this later that we'll speak to. So here's the economics, and it's kind of interesting. So for a project of this size, for a base metals project of this size and mine life, what you're hoping is to get a post-tax internal rate of return of better than 10%. And we've got 11.4%. Now, what's interesting here is if you look at the pre-tax internal rate of return, it's 11.1%, you expect the post-tax internal rate of return to be lower than the pre-tax internal rate of return. In this case, it's higher. And I'm going to ask Lyle to speak to the reason for that.
Sure, Mark, thanks. Recently, the Canadian government has announced a clean technology manufacturing investment tax credit, which is actually a refundable tax credit. Kind of mirrors the stuff that's being done in the US with the Investment Recovery Act, where companies are getting some sort of rebate money up front rather than getting it back out of taxable earnings later on. And so we actually get some cash flow out of this as refundable tax credits very early in the project life. And that's what helps change the paradigm. And this is a step that's being taken across the Western world, in different forms in order to really ensure that we're able to control our own supply chains. The governments have recognized that it's really important that we not just rely on China and Indonesia for everything. And we want to have some control ourselves. So they're taking steps now to incentivize resource extraction all the way through manufacturing. And we've seen the numbers with some of the big battery plants. It's going to be the whole supply chain. So, we're very pleased with the Canadian government's move on that.
So let me speak also to the nickel price assumption that we use, a long-term nickel price of $9.75 a pound. That price is 19% lower than the 20-year average price of nickel in 2023 dollars. So we feel that's a conservative price. Currently nickel is, fairly volatile. It's been reacting negatively to the slowdown in China. And nickel's like that. It is volatile. It goes up and down, fairly sharply sometimes. But, we're mostly interested in what the price will be, 5 years out, 10 years out, 20 years out, not what the price is today. And so, none of the strategics that we're talking to, none of the big mining companies, none of the car companies are assuming that nickel 10 years from now will be trading at anything like today's price. So, they're taking a longer term view. And we've got some slides later on that'll discuss this in more depth. So here's the price sensitivity. So if you take a price of $11.22 a pound, which is 15% higher, that is still below the long-term or the 20-year average price of nickel. And you can see how sensitive this is. The depreciated net present value post-tax gets over $1 billion US. Now, the low price of 829, the economics do not look particularly good. I don't think anybody in the business is expecting prices like that in the long term. Here we are in a good jurisdiction. Rule of law, of course. This is important to international investors. It's a mining jurisdiction. There are lots of open pit mines, particularly in British Columbia. And we are in territory that is claimed jointly by the Tahltan and the Cascadena. And both those nations we have ongoing relationships with. They're broadly supportive of responsible mining development. They're supportive of economic development in their territories. So it's good. We're well located. Here's the mineral resource statement. A total of measured plus indicated of 1.5 billion tons, and contain nickel in the measured and indicated category of 7.4 billion pounds. And then the inferred category, there's another 5.3 billion pounds of nickel. Big deposit. We now have mineral reserves study. And so you take the measured plus indicated and the stuff that you're mining, if it's profitable, turns into reserves. And our total proven and probable reserves are just under 1 billion tons, with 4.2 billion pounds of contained nickel. This ultramafic intrusive, if you look at the Horse Trail Northwest area, which is where most of the drill holes are, that is where the mine, that is where the open pit will be. But we've got discovery potential all through this intrusive. And if you look at the cliff zone to the right, we've got a few holes in that historically. We've just never had the budget to be able to drill out these other zones properly. The cliff zone's interesting. It's got nickel, copper, cobalt, and a higher platinum and palladium than other parts of the deposit. It's quite interesting. The Hatzel zone has got good grades. It's on the other side of the river. That's not included in the mine plan. And then all of the other zones, we've got drill holes that are broadly similar to what we've got in the Horse Trail zone. So, this 30-year mine life, we all believe that, ultimately, if you can get this project up and going, you will be able to expand at some point. So, we can't prove that today because you have to do the drilling before you could actually claim it. But we can say that there is a lot of potential for future discovery within this ultramafic intrusive system. Lyle, if you could speak to the processing flow sheet.
For sure. So one of the changes that we've made since the PEA is a little bit of a change to how we're going to build the plant, but the processing flow sheet is effectively the same. It's a very straightforward and simple flow sheet. Bring the ore out of the mine straight into a primary crusher. We do have a low-grade stockpile, but it will be a relatively small feature of our project. Once we've done that primary crushing, the material is conveyed across the river and up the hill into a crushed ore stockpile that feeds our mill, which is located above our tailings pond. And we like this approach because it means that we're conveying rocks instead of pumping slurries. And then when we go to the tailings, it means that we're using gravity flow instead of high pressure piping and pumping of these slurries that can lead to more problems. Coming out of the crushed ore stockpile, we have a secondary and tertiary crushing circuit. The secondary crushing with the cone crusher is very standard. The tertiary crushing is actually with a high pressure grinding roll, which we tested in a pilot test at UBC this year. It's an amazing piece of equipment. I was blown away by how quietly, how dust-free, how efficiently it runs, low energy consumption, and it just crushes the material by compressing two rolls together and pushing the rocks against each other, and it does an amazing job. Coming out of there, we have two ball mill circuits in series. Of course, all of these are closed circuit to make sure that we actually do what we want to do, which is get to the right particle size at the end point for efficient flotation. The rougher flotation circuit is big because we've got a big mine. We're looking at processing 30 million tons a year or 90,000 tons a day of ore. So that rougher flotation circuit is very large. But once we come out of that, the flotation circuit gets quite small because we're dealing with a relatively high grade material after that. 3 stages of cleaning, some scavengers on the first cleaner to make sure that we don't throw any material away that is recoverable. And the tailings go out to our tailings management facility where they'll sit there and work to sequester carbon as well as be safely stored, and concentrate goes off to market. There isn't a lot of difference in the flow sheet. We don't have to have multiple different recovery schemes, multiple different technologies in place. It's all just very standard flotation circuits, such as have been used in the industry for a very long time. We've got that primary crusher adjacent to the mine that reduces how much hauling we do, but then we've got the process plant located in the best place to allow us to do the processing and get the material, the bulk of the material into the tailings afterwards. Next slide.
Yeah, thank you, Lyle. So simple equals low risk. And part of this that's quite interesting, and it comes out of the development of the recovery algorithm in part, but also just extensive metallurgical testing. We know that we can consistently create a high grade, very clean concentrate. And, that part is, again, the error bars are very narrow between what is predicted and what is actually recovered. So that is, again, a huge de-risking of this project that we're all quite excited about. Lyle, do you have anything to say to that?
Just a couple of things. The nickel sulfides are declining globally, and we know this product is going to be in high demand for the future. The grade is fantastic. Very typical in the nickel business is 10% nickel in concentrate, because you end up with a bunch of nickel in other minerals besides the pentlandite that is your primary product, and you have to recover additional minerals like pyrrhotite in order to get a high recovery of nickel. Because 99% of our recoverable nickel is in pentlandite and other higher grade nickel sulfides like millerite and hazelwoodite, we've got effectively no nickel tied up in low grade pyrrhotite. So we get to make a very clean product, and it's clean of the really nasty impurities that all processing facilities hate, like arsenic and selenium and mercury and others. And that makes it a very desirable concentrate. Good for smelting, also good for pressure oxidation.
Yep, and a part of that too is if you're a smelter and you're buying, let's call it dirtier concentrates, you can use a product like this to blend away your problems with the other concentrates. So, we think ultimately the smelters would pay more for this product, and they'll certainly pay a lot less for for a dirtier, lower grade concentrate. Big mine. So, average of 35,000 tons a year of nickel and 2,000 tons a year of cobalt in the typical years. And this shows the production over that time. So this is a new slide. This is information just released, and we haven't totally figured out all of the implications to this. But there's a lot of battery plants being planned to be built in North America. And, there just isn't enough supply of nickel and cobalt to feed those plants. There's also not enough refining capacity in North America. This is a huge job that we're facing, to build a supply chain that can feed this beast. It's just so much has to be done, and it all costs money. And what I'm finding is that some of the car companies are starting to figure out that they're going to have to invest in the supply chain themselves. You can't just sit back and wait for other people to spend the money. Some of them have not figured that out, but some of them have. And so it's encouraging, it's interesting as we talk to the strategics. But there is a ton of work to be done, including building new mines such as ours. And there really isn't much in North America. The total refined output in North America of nickel is only 102,000 tons in 2021. Just nowhere near what we need. The Inflation Reduction Act is helpful. And, I'm not going to get into too much detail of this, but at least 50% of battery components in electric vehicles will have to be from friendshoring. In other words, from countries that the United States has free trade agreements with, in order to qualify for tax credits. And that this is expected to increase the U.S. energy transition demand for nickel. And it's just, we're looking at demand for this that's 23 times higher in 2035 than it was in 2021. And also it's being predicted, LFP, which is a nickel-free battery, which has lower energy density and is heavier, but it's eminently suitable for some applications. In North America, it's not expected to be as large a part of the picture as it is in other jurisdictions such as Asia. And I think that's mostly because in North America, drivers are looking for range. And if you want range, you have to have nickel. And it's just incredible numbers, coming forward. If we go out to 2040, ultimately, we're looking at batteries being more than 30% of the nickel use. I think it's around 16% right now. So just demand for nickel in that form is just going crazy. And this is interesting. I talked about the nickel pricing earlier. The black line is pricing adjusted to 2023 dollars. And again, the average price is over $11 a pound. So again, our competition for nickel supply is Indonesia, and Indonesia is just going nuts in terms of expanding nickel supplies, but they're doing it at a great environmental cost. So there's a big difference between an open pit mine. It's a big hole in the ground, but the aerial extent is not that great relative to the amount of rock you're pulling out. These laterite mines are strip mines, so they're thin, maybe 10 meters thick, and they run on and on and on. And quite often, they've got tropical rainforests in Indonesia and Papua New Guinea. They've got tropical rainforests on top of them, and they're just ripping down those forests. They're hurting biodiversity. They're quite polluting, and they're extremely high carbon intensity. So in talking to some of the European car companies, they are not interested in sourcing nickel from Indonesia because they're concerned about their premium brands. They don't want to be associated with the kind of environmental degradation that is happening. Our tailings management facility has been designed to be safe, above all, safe. And as part of it, here's a plan view. We're going to have a lot of exposure. We're going to have a lot of what they call beach. So the silicate tailings, which will be ground up fine, like a sand, they've got a lot of surface area exposed to the atmosphere. And so this is all about absorbing CO2 from the atmosphere. This will be, the tailings management facility will be a big carbon sink. Now we haven't included the sequestration of CO2 in our estimates of how much carbon this project will produce, but we plan to do that in future. It's significant. And sulfide is simply low carbon. We're dwelling on this because, again, a lot of the strategics, this aspect is extremely important to them. And so we've gone from the PEA to the PFS. We've dropped our carbon intensity, and our long-term plan is to drop it even more, possibly to a carbon neutral mine. So we've announced the PFS as of today. People ask me what's the next step. Well, it's deal time. There have been a lot of strategics waiting for this pre-feasibility study. They're interested in the project. I believe that we've delivered something that will solidify their interest. And so we're going to be extremely busy. Today's the starting pistol. We're going to be extremely busy for the next few months. Here's our board. I've talked about this before. I'm working very closely with our president, Martin Vidra. Martin is running our own internal process in terms of finding partners. And I give Martin full credit for finding Mitsubishi. So step one, we've got our first partner in place. And frankly, I also give Lyle Trytten a lot of credit for that, because he provides the technical competence that a potential partner wants to see. He's a very credible engineer, and Mitsubishi is very happy to work with Lyle. So this is a pretty dynamic duo, Martin and Lyle, both ex-Sherritt. We're very lucky to have both of them. Here's our capital structure. And there we go. That's the end of the presentation, and I guess we're open for questions.
Thanks, Mark. I appreciate that very much. We have had a number of questions already come in from the audience, so I'm going to start jumping right into those. And keep in mind, you can still ask questions in the chat panel on the right-hand side of your screen at any time. And if we don't get to your question for whatever reason, or if you're like me and you come up with the perfect question one moment after it ends, you can reach out and we'll be sure to get back to you. The Giga team will get back to you with an answer as soon as possible. But jumping right off, the question from Sandy, and this is presumably to Mark, but he asked what the model you have in mind to find the remaining capital will be.
We have no intention of doing financings by issuing stock. We think there is such a disconnect between our market capitalization and what this project is worth that it just makes no sense to raise money on the basis of our market capitalization. So we're looking for a similar structure to what we did with Mitsubishi. We have this joint venture company that we formed. We own 85%, Mitsubishi owns 15%. We're looking at selling another piece of what we own to another partner for, Mitsubishi got in early. We've used the money that they put in to improve the project and to de-risk it significantly. We think that the pieces of the project are now worth more than Mitsubishi paid, and how much more will be a matter of negotiation. However, we've got a pretty good idea of what we need to raise to get it to final investment decision, including all of the geotechnical drilling, the engineering, ongoing metallurgy, but also the environmental assessment. We think we're looking at something on the order of $50 million US to get this to final investment decision. So that's the kind of money we're looking for. And we're not going to do it by issuing stock.
Appreciate that. And the follow-up question you did sort of touch on in the presentation, I think it's always worth reiterating. We asked, when capital is found, how long will it take to build the mine?
Over to you, Lyle.
So with permits in place and capital in hand, it's really about a 3-year construction project. It's what's being modeled in the pre-feasibility study by the engineering team. There might be a little bit of early work in the year before that, just in road prep and stuff, but it's about access first, and then once you get in there, going hard to build stuff. Unlike a lot of mines where there's a lot of pre-stripping of waste materials to get to the ore body, we don't have that situation, so we don't have to spend 3 years digging up waste. It's really about building the processing facilities, and then because the ore is very near surface, we can start mining right away.
Yeah, and it's also about building the power line and building the road. So you have to build the road before you start moving in heavy equipment and heavy pieces of processing equipment.
I appreciate that. Jason asks, what potential impact the PFS will have on government support towards infrastructure for the project?
Well, I'm hoping it has a very significant impact. Just every step you take forward in terms of doing more detailed engineering gives the project more credibility. And we've got quite a lot of credibility with management now, just by virtue of having a partnership with Mitsubishi Corp. I can't emphasize that, over much, because they are a very credible company. I'm going on a trade mission next week to London and Paris with the Minister of Natural Resources, Jonathan Wilkinson. And, I'll have an opportunity on that trip to talk to him directly and to the Deputy Minister. And frankly, I'm hoping that the Assistant Deputy Minister will be there, because these are the people that, if they ever do a cabinet shuffle, they provide the continuity people at that level. So, but we're looking for help with the infrastructure. We would love to have government participation in extending the power line and in, building the road. And so there's federal money that has been earmarked for infrastructure investment to support critical minerals projects. And we think some of that should be spent in British Columbia rather than all of it in Ontario and Quebec. So anyways, it does help. Having this level of engineering, I think, will help to advance those conversations.
That makes sense. Barry mentions, he's quoting Robert Friedland here, who apparently recently said to not invest in British Columbia because in wet climates, the tailing dams are a risk. And Barry's looking for both Mark and Lyle's just comments on that comment. If you have any response or interest, or a couple audience members who noted they were interested in your response to that recent quote from Robert Friedland.
I'll give that one to Lyle.
Sure. I think that's really interesting, Romeo, and it's a good question. I think what people have to realize, and maybe some people don't understand British Columbia well enough, but it's a really big province with a lot of different climate zones. And there's really, really wet areas, and there's really, really dry areas, as we've seen over the last year. And there's been very successful mining of large-scale projects in BC for a very long time. Where we're located, we're in the rain shadow of the coastal mountains. So you go a couple hundred kilometers to the west of us into the coastal mountains, and you get meters per year of rain. And we're in an area where we get not a lot of rain. It's about 570 millimeters a year of total precipitation, rain and snow. And of course, being north, a lot of that falls as snow. We don't get the extreme storm events because we're in that rain shadow. And so that actually adds a lot of safety aspects towards the tailings compared to building in many other jurisdictions of the world. In the tropics, you've always got, or on coastal locations, you always have to worry about tropical storms. Look at what they experience on the eastern seaboard of the US and Canada every year. And even what we've seen in the lower mainland in the last couple of years. Being a bit inland, it increases your distance from shipping a little bit, and that costs you a little bit, but it really increases the safety factor. And it's not just the rain, it's also when you look at things like seismology. We're in a very low earthquake risk zone, and you can't say the same for tailings facilities being built in the Ring of Fire.
I appreciate that. I feel like I often am explaining how big Canada is to people. Just a lot of space, a lot of differences, and even provinces are huge. I appreciate that answer for sure. Jason, sorry, Mark, if you have another comment.
Well, I just want to expand on that a little bit. We are paying a lot of attention to the tailings management facility. In dealing with the Casca Dena, they are downstream. The Turnagain River flows north into Casca territory, and they really like the Casca really like the Turnagain River, and so we know going in that our challenge is to show them that we've got a tailings management facility that is safe, that is where the risk is as close to zero as you can get it. And we've done that. The extra money being spent to do that is embedded in, our financial model doing a lot less with the tailings management facility than we've decided to do. It's designed to be safe. And also, the question about rainfall is quite good. Our water balance in this project is pretty close to neutral. We're maybe slightly in deficit. So it's good. We will be recovering water from the pond that's in the middle of all these extensive beaches. Again, we are going to have to show the Casca Dena, and we know we are, that our tailings management facility is designed to be safe, and if anything is over-engineered.
Appreciate that. One question, just a quick practical question from earlier. I think we can wrap up pretty quickly. If somebody's asking whether the 50 million number that was quoted earlier is in Canadian or US dollars?
US dollars.
Perfect. Thank you so much. Jason asks, from a practical standpoint, do you anticipate the de-risking of the project to capture the attention of the newly hired metallurgists within battery and OEM companies?
Yes.
Short and sweet. Like it. Thank you very much. Gordon asks, has Giga had and obviously only answer to the best of your ability, but has Giga had discussions with CV?
Romeo, can I just interrupt for a second? I'd just like to touch on that point. It's great that the car companies are going this route and hiring their own internal specialists. These are the people that they need. It's really important that they understand the risk profile and the opportunities of any projects that they're thinking about. As an engineer myself, I've done a lot of due diligence work on projects globally for many, many years. I've worked on Turnagain now for 4 years with Mark. It's been a great experience. I look forward to those conversations. And Mark mentioned that Mitsubishi brought on a due diligence team before they invested in the project, and they've kept them on through the entirety of the pre-feasibility study. And I've been meeting with them every month and having these discussions about the mining, about the metallurgy, about all aspects of the project. And they've been very helpful. In general, they've been very pleased, very positive. They've brought forward some good suggestions as well that we've taken on board as we look at the project. And those are great discussions to have because it gives everybody confidence, not just them, but also us. It gives us confidence that, what we think is the right thing is the right thing.
Oh, thanks, Lyle. Appreciate that extra context. The one question from Gordon is, has Giga had discussions with CVMR Corp?
Not to the best of my knowledge.
Perfect. One question from Dal, and Dal, please correct me in the chat if I'm not guessing what your acronym is, but I believe he's asking what are the total costs at Turn Again?
The total capital costs?
I believe so.
1.9 billion US.
Perfect, thank you. One question that's a bit on the technical side, quoting from the PFS here, the resource will be selectively mined with low-grade materials placed on a low-grade ore stockpile for later recovery. He asks if you're moving the ore already, isn't this a more capital-intensive approach?
Lyle?
Realistically, when you have low-grade ore in place, you've got two choices. You can put it to stockpile or you can process it directly. And it's about managing your cash flow. And in an operating mine, these decisions get made all the time, every day. What's the best thing for us to do today? Put it on the stockpile and incur extra cost to process it later, but that lets us process something that's worth more today, or just put it through. And these are very standard decisions. You can just run it all straight through. It's entirely feasible to do that. What we've done with the pre-feasibility study is dramatically reduce the amount of stockpiling compared to the PEA. In the PEA, we had a very aggressive stockpiling approach that ended up building a stockpile of about 200 million tons that we then operated the last 7 years of the PEA, years 30 to 37, we're simply consuming stockpile. What we've got now is a much smaller, more conservative approach. Total stockpile gets to about 34 million tons. We use it up at the end of the mine life in that 29th and 30th year. We feel that it's a much more rational level. We can always go more aggressive. We can always go more conservative, but it feels like about the right amount to both manage cash flow within the company and manage regulatory expectations. Nobody really wants a big stockpile sitting there. They understand it's a necessary part of mining, but we have that flexibility.
Appreciate that. One question, what percentage did you use as a buffer / contingency costs?
Yeah, so we've done a lot of engineering on this project over the last year. In fact, I sat down with the engineering company about 6 or 8 weeks ago, and they said, from the point of view of the process plant and all the equipment and everything else, you could just call this a feasibility study. Like, you don't really need to call it a PFS. So yeah, but realistically, we have other uncertainty areas that drive us towards calling it this, right? We need to understand a bit more about geotechnical matters and things like that. So it will be a PFS. We've got about 14% of the direct costs as contingency within the project, and with that really good level of definition of the engineering. We've got layouts and section drawings and every elevation drawings for all of the process plant equipment. We've got quotes for all of the major equipment, bills of material for installation for everything, motors from 50 horsepower up. So we've got a really good level of definition, and 14%, having been in the metallurgical business for a long time and built a lot of projects, it's a very reasonable number to have at this point. Of course, things can go better and things can go worse when you get into practice, right?
Yeah, it's interesting that the capital cost is pretty much the same as it was in the PEA. There has been significant inflation since the PEA. We frankly expected the capital cost to be higher, but again, the engineering company is out getting quotes on major equipment, so this is not a factored estimate. They went and got quotes, and so we feel good about this. Also, some of the off-site infrastructure actually went down, and so that sort of balanced out any inflationary effect on some of the equipment. I just want to leap in and answer a question that maybe people aren't asking. So in our financial model, we use a 7% discount rate for depreciated net present value, and typical is 8%. And, some people might, roll their eyes a little and say, well, that's kind of aggressive. Like, why are you doing that? The reason we're doing it is because Mitsubishi is our partner. And if this project actually gets built, the price of money will be even lower than 7%. And so we felt that 7% was reasonable, and the engineers felt that 7% was reasonable. So that's the reason. We've got a partner where we know that the cost of money isn't going to be as expensive as it might otherwise be.
And if logically anybody can explain to me why gold projects are okay at 5%, but base metals projects need to be at 8%, I'm all ears.
So one of those industry questions. One question, were the recoveries, that 52%, in line with your internal expectations?
Wow.
Yeah, broadly they are. We expected it to tick up a little bit. We've got some work ahead of us still on the recovery side. There's a set of assays that we didn't do for, it's now about 15% of the deposit that we drilled in the last several years, that we think offer us some upside as we look to improve our recovery algorithm a little bit more than what we're using in the PFS already. Higher precision yet, and we think there's a bit of upside there, but they're broadly in line with our expectations. For the good ores, we'll get 70-75% recovery, and for the marginal ores, it will be a lot lower than that. And over the life of mine, it averages out. Because a portion of our nickel is in the silicate host rocks, it's unrecoverable unless you want to build a 30 million a ton silicate ore leach. And pour an awful lot of acid on it, which we don't think is a practical or appropriate thing to do. The sulfides are what's recoverable, and those are the ones we're going after. And it's about 2/3 of our nickel is present in sulfides. And so when we get about 52% recovery, that's about 70% of the sulfides, and that's not an unreasonable value.
Oh. Yeah, and some people might look at that and go, well, 50% is a pretty low recovery, like if you're used to copper porphyries, for example, which have a completely different deportment of the sulfides. But if you look at other large, low-grade, open-pittable sulfide deposits, a lot of them have recoveries ranging from sort of 39% to 42%. So our recoveries at 52% are actually excellent compared to our competition.
Thanks for that extra context. I think we got time for one last question. It's a short one from Jim. He asked, is Mitsubishi willing to finance 100% of the capital?
No. We're looking for partners to spread the risk. Typically, Mitsubishi likes to have 20 or 25% of the project by the time it's an operating mine. They don't want to operate. They're very keen on getting a major mining company in as a partner to actually build and operate the mine. And they're active in helping us search for that partner. So no, this is a $1.9 billion capital cost. They do not want to take 100% of that risk.
Appreciate that. And generally, I want to thank both of you, Mark and Lyle, for taking us through the presentation and to the Q&A. Everyone who attended, there's quite a few of you in the room. Really appreciate everybody who made it out, and also those who asked questions. But with that, I'm going to hand it back to you both for the final word before we sign off this morning.
Well, my final word is that I believe, and first of all, congratulations to Lyle. He was at the center of this process. It's a lot of work. And he dealt with all of the engineers from all the different disciplines to get this PFS project done. So kudos to Lyle. And we've accomplished what we need to accomplish. When you're talking to major mining companies and car companies and so forth, the financial part of it, in terms of what nickel price are you using, what what payabilities are you using and so forth. They've got their own price decks. They've got their own assumptions about, payabilities. But what they're looking at really is, do I believe the capital costs? Do I believe the sustaining capital costs? Do I believe the operating costs? Do I believe the geological model? Do I believe the metallurgical recovery algorithm? And, we've put together a document that is very, very thoroughly answers all those questions. Thanks to Lyle.
I just, like to close off, Mark, by saying that, we understand that everybody who's watching this and participating, and thanks for those great questions, is weighing a number of different projects. If you're interested in the nickel space, you know who the players are, and you're looking at different options. And the one thing that I would say is running a big mine is running a big mine. And what you really want to look at the end of the day is, what's the capital and operating cost to deliver how much mined material and ore to a process plant? And, if you look at numbers and one project has a sustaining capital that's really low and another one has one that's really high, like maybe neither one of them are right, but the number should be about the same at the end of the day. If you're going to move 1 billion tons of material, it's going to cost you about the same, right? And that's total ore plus waste. If you're going to move 1 billion tons of ore and your waste ratio is 0.4 or 2, it's going to cost you a very different amount compared to the amount of ore that you have. So, when you look at projects and stuff, just think about, the reality of the numbers and adjust accordingly. And if that means you adjust ours up or down according to your experience, then hey, that's in your hands to do.
Awesome. Well, appreciate both your time today. And of course, everyone who attended. The recording will be available soon. I hope everybody has a great day.